khair. Good morning, everyone. Welcome to the General Secretariat of the Supreme Council of Planning and Development to the KPPC lecture series, Kuwait Public Policy Center. Today is our 13th lecture, and we have a very special guest that will be talking about an important thematic issue, the global economic outlook and risks. So this lecture will focus on the outlook for the global economy and how risks such as a global trade war, slowdown in China, will shape the likely economic outturn over the next few years. It will also use the Kuwait macroeconomic model to show what impact a business as usual scenario would have on the medium-term outlook for the economy. Today's lecture series guest is Mr. John Walker. He's the chairman and founder of the Oxford Economics, which was originally a commercial venture with Oxford University Business College to provide economic forecasting and modeling to UK companies and financial institutions around the world. Expanding abroad also, he has guided Oxford Economics to become one of the world's foremost independent global advisory firms, providing reports, forecasts, and analytical tools to over 1,500 clients across the world. Without further ado, allow us to warmly present our speaker today, Mr. John Walker.
Good morning, everybody. It's a great pleasure to be back here in Kuwait. When I came in yesterday, I explained that I came first in 1987, and the immigration person looked very confused, trying to find something in the computer back to 1987, but it didn't cause any problems anyway. I enjoyed my visit then. It's a long time I've been away, but it's a great pleasure to be back here, and I'm very pleased to be able to give this lecture today. As you heard, Oxford Economics now is a very large firm. We have getting on for 250 economists, and as you all know, two economists never agree, and my role is partly to get those economists to agree about what's going on in the world. Everyone has to compromise, but part of the fun of what I do is producing a central view, a coordinated view of what's going on for the world economy, and it's one of the reasons I still enjoy doing the job I do. The other reason I enjoy it is that I get to talk to very many different people in many different parts of the world. One day I'll be talking to machine tool companies, and they're mainly focused in Japan and Germany and the United States, but they sell their machine tools a lot into China and therefore very strongly dependent upon China. The next minute I'm talking to central bankers or investment bankers who are worried about what's likely to happen to interest rates tomorrow in terms of their derivatives models. Next moment I'm talking to people in the oil sector, like today, when the main focus of attention is what's likely to happen to the oil price. And I hear very many different views about that every single day of the week. Is it going to go up? Is it going to go down? And what are the consequences for the world economy? What I'm going to do today, however, is present firstly our picture for the global economy as of today. There's lots of developments going on. We saw what happened at the G20 meeting over the weekend, and issues about trade policy will be a key part of that debate. But an important question will be, where is the oil price going? Because I think that still has important impacts for the global economy. Following that, I'm going to say a few words about Kuwait. We have big teams looking at the large economies. We have smaller number of people looking at the more regional economies, but we still have people looking at Kuwait, and I'll present our views on Kuwait. And then finally, I'm going to say some words about the work we've been doing with the Council, developing a macroeconomic model for the Kuwaiti economy, looking at some longer-term scenarios that come out from that, and give hopefully some starting insights on what the implications might be for Kuwait over the longer term. It's a very large number of things to cover in an hour, so I'm going to have to go relatively quickly, and so please excuse me if I rush one or two or go through relatively quickly one or two elements of the of the presentation today. But hopefully we'll have a little bit of time at the end for questions and answers. And after that, if people have got any questions, I'm more than happy to answer them by email or whatever. So to get underway, let me start with broadly what we're going to cover. We're going to look at global developments, the outlook and risks. That's the global economy section. Then say a little things about the GCC overall, the developments and shorter term issues, and then some scenarios towards the end of the presentation. I mentioned I talk to a lot of different people, but I suppose one common theme that I get asked about all the time is we've had a relatively strong expansion for the world economy, particularly the US economy, over the last few years. Is a recession around the corner? Is there going to be a sharp slowdown in the US economy in particular in the next year or so? And you can see from this first chart why people are concerned. This shows the length of various economic expansions, and you can see that this current expansion now is the second longest that we've ever had over the last 150 years. So clearly there must be understandable concerns that the strong growth that we've seen in the US is now coming to an end. And our view is it is, but not yet. We still think that, particularly in 2019, the US economy will remain relatively strong, and for that reason, the global economy will also still remain relatively strong. Why is that true? Well, we argue the global economy is in the early stages of a slowdown, and I'm going to go through the signs of that, but I'm going to point out that that does not mean that a recession is around the corner. What are the signs of a slowdown? This first slide, or this next slide, shows you the picture for world trade. You can see the strong collapsing world trade in 2009 and the strong recovery. Since that time, global trade has done relatively well, but you can see that recently trade has slowed relatively sharply. I think we would argue that slowdown in global trade is not now a good indicator of what's happening for the global economy, partly because of the trade wars that are going on, but I think partly because there's a much bigger change going on for the world economy, and that's a move against globalization. Globalization was a huge force for the world economy over the 30 years up until about 2010. But that has clearly gone into reverse. And President Trump's trade protectionism is one sign of that. But I'd argue that in my own country, the UK, Brexit is a further sign of that. The move against globalization, I think, will be a strong feature for the global economy over the next 10 to 20 years. Another potential sign of a slowdown has been the sharp fall in equity prices that we've seen over the last 6 weeks. As many of you know, there's been a sharp sell-off in particularly developed country equity prices during October and into November. I'll go over occasionally and look at the charts and show you that, but you can see the big fall that we've seen in equity prices over the last few weeks. Clearly there's a concern that that also might be indicating a slowdown for the world economy, and clearly it's a concern and will affect wealth for people that hold those equities. A final sign potentially of a slowdown has been the sharp fall in oil prices that we've also seen over the last few weeks. Many people are arguing that oil prices will go down much further over the next year, and they argue that that's a sign of a sharp slowdown in demand for oil, and therefore a slowdown in the world economy. Our view is it's more driven by increases in supply than a decline in oil demand. But clearly, it's a further indicator that perhaps the world economy is slowing sharply as we go into 2019. So those are the reasons why people are worried about the slowdown turning to recession. But we would argue that if you look at a number of other indicators, things are not that bad. Firstly, there's surveys, business surveys in particular, and we look at various global surveys of the PMI, the Purchasing Managers' Index, and you can see that those have slowed a little bit over the last couple of months, but nowhere near the sharp slowdowns we saw in those other indicators. So more broad indicators of what businesses think is going on certainly don't indicate a sharp slowdown in the global economy. And we therefore think that we would then argue that there's a number of reasons to be relatively optimistic about the global economy in 2019. Firstly, there's this robust US growth that I've already indicated, and we still believe that US growth will be underpinned by a huge fiscal stimulus that's going on in the US economy at the moment. I'm sure many of you don't follow the details of US fiscal policy, no reason why you should, but a couple of measures at the start of this year, big tax cuts, particularly for business, but also big government spending increases, have hugely boosted the US economy, not just in 2018, but also 2019. Those things are staggered through this year and into next year, and according to our US economists' calculations, those are going to add 0.5% to US growth this year and a further 0.5% to US growth in 2019. So the fiscal boost to the US economy is not just for this year, it also continues into 2019. And that, we argue, is going to help keep the US economy growing during 2019. Other reasons to be optimistic, you can see from the next couple of charts. Firstly, employment growth in the US remains very, very strong. This shows monthly employment growth, and then the 3-month average and the 12-month average. All of those indicators show you that the US real economy continues to go strongly as we move into 2019. And a further sign of that is not just that employment is strong, consumer confidence is also very strong for the US economy. Particularly look at the blue line there. You can see that consumer confidence in the US is actually stronger now than at any time since 2000. It's even stronger than what it was during the strong growth that we saw in the US in 2006, 2007, and so on. So there's plenty of reasons to think that the US economy will continue to grow in 2019. Second reason to be positive about the world economy is clearly there's been lots of concerns from our clients and everywhere about the protectionist policies of President Trump. But if you look at the impact of those policies so far, they're relatively modest. Clearly there's concern that they could become much more widespread, but if you look at the actual tariffs implemented so far, as you've seen over the weekend, the next increase in tariffs on Chinese goods has actually been delayed for at least 3 months, then those tariffs are not going to have a huge impact on the US economy in 2019. I won't go through the details of these charts. You can see them when you hopefully take away the presentation later. But essentially what they show is that about 3% of world trade is going to be impacted by those tariffs. A relatively small proportion given how huge world trade is overall. So the tariffs are going to affect particular sectors, but they're not going to hugely impact the overall growth, certainly of the US economy. They might have a bigger negative impact on the Chinese economy, and I'll turn to that later. But the impact of those tariffs on the US economy so far are very, very small. And on the Chinese economy may be bigger, but I'll turn to that in a moment. The much bigger impacts, this is another illustration of that. This shows the direct impacts of the tariffs on overall GDP for the US and China. And you can see you're talking about taking maybe 0.2, 0.3% of US growth in the next 12 months, considerably smaller than the fiscal stimulus that I showed you a few moments earlier. Now, there might be further impacts coming from trade diversion and so on, and there may be confidence in other effects on top of that, and that chart shows it there. But our final view is that the impact of those tariffs on both the US and China is going to be relatively modest. And I think that's a critical part of the story that I want to get across to you. The third element of this part of the story is that China may well be more negatively impacted by the protectionist policies than the United States, but Chinese policy is sufficiently flexible and they're taking active measures to offset the negative impacts of the US protectionist policy on their domestic economy. So, as it says here, Chinese policy will strongly resist the effects of that slowdown. And you can see that certainly in terms of exports so far, there's been no sign of the protectionist measures slowing US exports, either to the US or to other countries around the world. You can see that if you look at domestic demand indicators, there's been a gradual slowdown over a long period of time, but nothing recently suggesting that the Chinese economy is going to slow sharply. And this chart's got a lot of words on it, but essentially what it does is go through, again, what our Chinese economist is saying, that there's a large number of monetary and fiscal and other measures that the Chinese government is introducing to limit the slowdown on the Chinese economy in 2019. Partly that's political. They want to show that they're not being affected by US policy, but it's partly because they have the ability still to control that economy really quite tightly, and they're introducing those measures to limit the effects of the slowdown. So clearly, we're concerned about what those measures might do, but you can see that our central forecast does show China slowing a little bit in 2019, but certainly not significantly as a result of the protectionist measures that I've just talked about. Final area of the world I want to talk about in this section before I turn to emerging markets is the Eurozone. There's lots of concerns in Europe. One of them is Brexit that I touched on a few moments ago, and there's still a lot of uncertainty about that will do. I think one important thing to say, and I'll come to it in a while, is that it could have significant negatives for the UK, but the negative impacts for most of the rest of Europe and certainly for the world are relatively small. Italy is also a concern in Europe, and there are also some political concerns in the former bits of Eastern Europe. But so far, Europe has slowed quite a bit in the last year or so. We don't think the strong headwinds that Europe has faced in the last year will continue into 2019. And I think that's a quite important difference between our view and some other people's views about the European economy. So it will face fewer headwinds provided that there's no hard Brexit and provided the Italian crisis is avoided. The first chart to show here is that Europe has slowed quite sharply during 2018, and we think we have a good explanation for that, and I'll turn to it in a moment. But there's no doubt, in contrast to the US and China, the Eurozone has slowed quite significantly during this year. Part of it has been the appreciation of the euro, particularly vis-à-vis the dollar, and that's certainly limited European trade performance. But the other important thing, and I think people often forget this, the other important thing that slowed Europe down in 2018 was the higher oil price that we started to see rising from the lows during 2016 up towards $80 a barrel during the summer and the end of the summer. Europe is a big importer of energy, much more even than China. And as a consequence of the higher oil price, real incomes were squeezed. And clearly now, with the oil price going down a little bit, that is going to help the European economy as we go into 2019. Certainly, sentiment soured, and the decline in equities was an element of that. Sorry, I need to go back a little bit. But the point I want to end in on the Eurozone is that the lower oil price, as I say, will, I think, enable Europe not to grow strongly in 2019, but to do relatively well. The final part of my presentation on the overall central forecast for the global economy is emerging markets. And sorry, I jumped a chart a few moments ago. And emerging market sentiment has been really very poor in 2018. Part of the reason for that has been financial outflows, and you can see that in the chart here. The strong US economy has led to rising US interest rates, and that has led to an outflow of funds, broadly speaking, from emerging markets. And by emerging markets here, I'm talking about Brazil, other parts of Latin America, Asia, Africa, all across the globe. A range of emerging markets have clearly found life much tougher in 2018. A lot of them, as a consequence of those financial outflows, have had to raise interest rates. And you can see Brazil, Mexico, India, Indonesia, Russia, South Africa, Philippines, the range of countries that I'm talking about here, all of them, because of the financial outflows as a result of the strong US economy, have had to raise interest rates, which has made life tougher for them domestically. And that's likely to weigh on their growth in 2019. So the one part of the world where we remain relatively pessimistic for 2019 would be emerging markets. The US is likely to remain relatively strong. China likely to remain relatively strong. The Eurozone likely to have some recovery. Emerging markets are going to continue to have a difficult year, partly because higher US interest rates as a result of strong growth, and partly because of higher domestic interest rates as they try to defend their currencies from the sharp falls that they were suffering. But I think it's important to realize that emerging markets in general are much more structurally sound in 2018, 2019 than they were, say, back in the late 1990s or back in 2008. Partly because of the Asian financial crisis at the end of the 90s, partly because of the global financial crisis in 2007, 2008. Many emerging markets now have a lot better current account positions, a lot better domestic fiscal positions than they had in previous years. So life is going to be tough for emerging markets, but we don't see an emerging market crisis arising in 2019. So to summarise that part of the presentation, our view generally is that the global economy is in reasonably good shape as we go into 2019, and there's little signs yet of a full-blown downturn or a recession. But that doesn't mean there are not risks of that. There's always dangers in the global economy. So I just want to say a few words about what potentially could go wrong. And I'm going to start by using a survey that we carry out with all our clients. As you heard in the introduction, we've got now about 1,500 clients around the globe, and on a regular quarterly basis we send out a questionnaire asking them what their major concerns are. And as you can see, the major concern that our clients have in terms of the overall global economy is a trade war, which would hit global growth. As I've indicated, the current measures implemented wouldn't lead to a huge collapse in global growth, but that doesn't mean there aren't dangers on that front as we go into 2019. Start off by trying to assess what President Trump's trade strategy is. It's not necessarily easy to assess what President Trump's strategy is on a range of measures, but I think his measures are clearly designed to achieve a number of things. They're certainly an attempt to get China to change its policies in terms of intellectual property and so on. They also want to generally impede China's growth. They clearly see China as a threat to their global dominance, and they therefore want to certainly put some brakes on the development of the Chinese economy. But we doubt whether it's really to get to zero tariffs by threatening higher tariffs. Some people argue that his changes are designed to get rid of tariffs across the world. Certainly that's not our view. Our view is that the main aim of his policy is to get US companies in particular to relocate much of their production, which historically was outsourced to countries like China and countries in other parts of Asia and Europe, back to the United States. We think that's a hugely important element of Trump's strategy. And if tariffs can't get companies to rethink supply chains, then he will have succeeded. If he can get them to do that, I think he clearly will feel he's succeeded in terms of his trade policy. And I think that means that you won't necessarily see huge increases in tariffs in terms of tariff rates, but you will see, certainly in our view, an extended period of using tariffs to encourage US companies to relocate. And therefore our view is that a quick end to this trade war is unlikely, but a huge escalation of the trade war is also unlikely. The aim of the measures is to impede China and to get US companies to relocate. That suggests that you will keep the pressure on China on these things, but you won't necessarily escalate things so they get out of hand. That would argue that the prospects for de-escalation in the short term are low, and I think that fits in with what came out of the G20 meeting on Saturday. They like to negotiate and so on. It's not clear what the Trump's demands will be. But we also think, I think there's an important thing at the end here, don't think that the trade war is just between the US and China. I think there's a genuine risk that Trump will turn his attention to other countries that clearly have upset him in terms of their trade policies. And a classic example of that would be Germany. Germany's policies, not just in terms of trade, but in terms of defense and in terms of NATO, are also at odds with President Trump. And therefore, don't be surprised if you see certainly discussions and probably even action on things like car imports into the US, especially given what General Motors announced in the last couple of weeks. Another thing that people are concerned about in terms of recession is Brexit. But as I've argued earlier, even a hard landing, which would have a really bad impact on the UK economy, doesn't really affect the large European economies very much. You can see France and Germany relatively modestly affected, even by a hard Brexit in the UK. So the other big concern that people often ask me about, as well as trade, is Brexit. And as you can see here, Brexit will have a big effect on the UK and then on other countries like Ireland. But even for Europe, a hard Brexit is not a reason to think there'll be a recession in 2019. Does that mean the recession will never come? I think the clear answer to that is no. Recessions are always, at some stage, likely to happen. And I think the important point I want to end up on in my talk about the global economy is that I've been relatively positive about 2019, and I think there's good reasons to believe that. I think there's a lot of reasons to be concerned about 2020. I think there's plenty of signs in the global economy that the very strong growth that we've seen globally over the last 2 or 3 years could well come to an end at some stage in either 2020 or 2021. Those are the years, I think, that are important years to be worried about in terms of the global economy. So this is not just an optimistic presentation saying things are okay. I think there's genuine reasons to be very concerned that the global economy will see a significant slowdown, maybe in 2020, but certainly, if not in 2020, by 2021. What are the reasons for that? Well, the first one is that fiscal stimulus in the US that I mentioned earlier. It's very positive for 2018 and 2019, but you can see it actually goes into reverse in 2020. So it's not just the measures come to an end. There will be, in principle, some fiscal tightening in 2020. So clearly that's going to have a negative impact on the US economy as we move into that very important election year for President Trump. The other reason to be concerned by that time is that with strong growth, US interest rates, which have already been rising quite sharply, they're almost certainly going to continue to rise, in our view, through 2019, getting up towards 3.5% or so. Those things on their own will also start to slow the US economy, and clearly that will be an important thing for interest-sensitive sectors in the United States. There's also signs around the globe that wages are starting to rise, so clearly there's a concern that strong growth will finally feed into higher wage increases for the global economy, and those, of course, will meet further interest rate rises as we go into that year. But it's not just those two things. The very big fiscal stimulus that we've seen in the US is leading to very high federal deficits. That will put pressure on long-term interest rates in the United States. I've not got a slide to illustrate that, but I think that's also quite well known. There's very high levels of debt in the Chinese economy. Again, many people are familiar with those numbers. The policy measures that China is currently following to offset the trade negatives on its economy will further increase Chinese debt, and that will also start to impact on the Chinese economy. But finally, and I think very importantly, and this chart illustrates it, for a long period of time now, for much of essentially the last 15 years, we've had a situation in which, for the global economy as a whole, the corporate sector has been savings. What Ben Bernanke, many of you may remember, called the global savings glut. Many people have been hoping that that global savings glut was going away. And there were clearly signs of that. This is what we think of as the best way of showing the global savings glut. It's corporate sector savings for the global economy. The corporate sector for much of the early period, the 1980s and 1990s, invested more than its income, which is what you'd expect the corporate sector to do. During this period of time, the corporate sector globally has not been investing on anything like the same scale as before. Its profits have been very high, and therefore the corporate sector's had a financial surplus. That financial surplus was very high in 2011 and was coming down very sharply, but you can see it's now gone into reverse. And I think that's very, very important because it puts a dampening pressure on the global economy over the longer period of time. And I think that is a further indicator that the relatively strong picture that we've seen globally is likely to slow down quite significantly as we move into 2020 and 2021. And that impacts our longer term forecast. As you can see here, world growth will be relatively strong in 2018, 2019, but will slow quite sharply, and the US in particular slow quite sharply as we move into 2020 and 2021, with clearly important impacts for commodity prices and oil prices as we go forward. I think we were having a debate before we started this session about where oil prices might go in the short term, and there's clearly quite a wide divergence of views. But if you look a little bit further out, significant signs of a slowdown for the global economy will obviously have impacts on the demand for oil as we go forward, with clearly consequences for this part of the world and Kuwait in particular. I won't do a summary of that. I think I've covered that hopefully relatively well. And I'm now going to turn to the second and third sections of my presentation, which will be quite a bit shorter. And I plan to talk for about another 20 minutes on perspectives that I have as an outsider on the GCC and Kuwait in particular. But then, perhaps much more importantly, talk about the work that we've been doing here on Kuwait, the model building that we've been doing here, and some of the initial numbers that are coming out from those scenarios and those simulations. This first chart just looks at GCC oil production and the oil price, and as you can see, GCC production slowed quite sharply during 2016-2017 as a result of the OPEC production limits, and remained relatively low through 2017 and the early part of 2018. But as you can see, over the last several months, oil production has risen quite significantly at the same time as the oil price was also rising quite sharply. But given the recent decline in the oil price, and whether this is because of OPEC measures or simply because of lack of demand for oil, we certainly see oil production being under pressure as we go into 2019, even though the global economy is likely to remain relatively strong. Now, I don't think this is just a GCC thing. I attend lots of conferences on oil, and clearly during 2018 in particular, there's been two big measures in place outside the Middle East region. Firstly, there's been a very big increase in Russian oil production during the last 6 or 7 months, much more than people expected. Many people believe that Russia could not increase its oil production very much because of capacity constraints. Clearly, with the high oil price, it has been able to do that, and many people have been surprised at how high Russian production has got during this year. The other thing that's very noticeable from my perspective, looking at the global oil market has been the very big increase again in US shale production. Many people were worried about the constraints, particularly in terms of pipeline constraints in the United States, and clearly those have played a part. But it's still been true that US shale production has risen much more sharply than many people expected. And those combination of things, together with an increase in GCC production, in our view, have led to significantly oversupply of the market, and has been one of the reasons for the sharp decline that we've seen in the oil price during the last few weeks. Clearly, a lower oil price and lower production is going to slow the recovery in Kuwait in particular. And these are our latest forecasts for Kuwait, as you can see. And there was a sharp decline in GDP, in particular in 2017, as many of you are familiar. There's been a significant recovery this year. Life is clearly going to be tougher in 2019, partly as a result of the constraints on production, and partly as a result of the currently lower oil price that we certainly expect to persist through into 2019. And that's likely to be true even if government spending remains relatively expansionary. These are our estimates for government spending increases across a range of countries in 2019. And as you can see, Qatar increasing government spending very sharply, obviously more dependent upon gas than oil. But other GCC countries, including Kuwait, all having significant increases in spending, partly because the oil price is still relatively strong, but nowhere near the increases that one might have expected if the oil price had been a little bit higher. A lot of numbers on this chart. It just looks at the reform measures being introduced across the GCC countries in terms of changes in electricity prices, changes in gasoline prices, and so on. And I think one of the things that does stand out from this chart, sorry if you can't read it all from where you are, but I think one of the important things that stands out is that in a number of countries, UAE in particular, there's been significant reform in terms of moving both electricity prices and gasoline and water prices back to more market-driven levels, and taking away the subsidies that have been in place. And clearly it's something that Kuwait is still moving relatively slowly on, and obviously is something that may change as we go through the next couple of years. This simply looks at Kuwait revenue by source, and again I'm sure many of you in this room are much more familiar with that than I am, but it makes it very clear how dependent the country is on oil revenues. There's been some increase in non-oil revenues as we've gone through the last couple of years, partly because oil revenues themselves have been weak, but it's still very much a country, as you know, that's very dependent upon oil. And this final chart, just as a sort of background, and again, many of you will be familiar with the numbers. These are World Bank measures of ease of doing business. And as you can see, again, some countries moving significantly up the scale, which means that it's easier to do business in the country. Kuwait and Saudi Arabia probably lagging behind again, countries like the UAE, and obviously not quite or anywhere near countries such as Singapore or the United States, where it's much easier to be able to open a business, run a business, and so on and so forth. Again, a sign of further reform that could well be implemented. Things are not all negative. Nevertheless, this shows some risk measures that we particularly put in place, looking at not just emerging markets, but countries around the globe. And if you still look at that broader measure of risk, Kuwait comes out as a very low risk economy for a whole range of I think, very good reasons. So the figures in terms of reform for Kuwait still are perhaps lagging behind some other countries in the region, but certainly in terms of the general perception of risk for Kuwait, still relatively low. And of course, one of the reasons for that is that there's substantial assets to deploy. This looks at foreign exchange assets, wealth, the broad measure of not just sovereign wealth funds, but also any foreign exchange assets that different countries have. And as you all know, Kuwait not only has very large amounts of those assets, but certainly assets in terms of head of population even higher than Qatar, for example. But I think those numbers do illustrate that there's still room for quite significant reform here in Kuwait. And I suppose one of the things, therefore, when we've been involved in building this model for the Kuwaiti economy that I'll say a few words about in a moment, is what the fiscal challenges are from current policies and what the implications of some reform measures might be. Before I do that, just let me say a couple of minutes about our broad approach to modelling and the work that we've been doing here in Kuwait, because I think it's very important in terms of understanding our philosophy about what we do. The thing that distinguishes us from virtually all our competitors in the economic forecasting and consultancy area is that we have this global macro model that looks in detail at about 80 of the major economies around the world. That covers not just the large economies, the US, China, Germany, Japan, and so on, but also a significant number of the smaller economies as well. And we have teams of economists in many of the different regions of the world working on those models and working together to produce the global forecast that I described to you a little bit earlier. None of our competitors do that. The major investment banks will have huge teams in London and New York and perhaps in Japan and elsewhere. We have significant teams of economists scattered around the world. So we have a group of economists, obviously, in the US and in China, but we also have economists in Germany, in Japan, here in the Middle East, in South Africa, in Australia, in Singapore. I forget the number of countries that we've got because I spend too many times trying to go to them. I end up jet lagged, as you can gather. But the point that I want to get across is that this system does allow us to have local support for the models, as well as be able to share information so that we can produce a globally consistent forecast. And one of the things we've been doing here in Kuwait, as well as in other parts of the Middle East over the last several years, is working with local people and local data sources to build a model for the Kuwaiti economy. It obviously takes into account the huge dependence here in Kuwait of oil, so that has to be an important element of the economy, and obviously the forecasts strongly depend upon what happens to the global oil price, and as we all know, predicting the oil price is extremely difficult. But there's a linkage between what's going on for the global economy and the global oil price through into the Kuwaiti economy. But then what we're also doing is looking at what the trends are in terms of employment, in terms of real incomes, and in terms of the non-oil economy, to look at what prospects are for Kuwait, for example, over the short term as well as over the medium term. Over the longer term, important long-term drivers of growth are taken into account. But in the short term, it's very much an econometric model based on what the data is telling us about what happens to this economy in comparison with other economies. And one of the points I make is that in one level, all economies are the same. If you give $100 to people in my own country, or £100, they spend most of that money on goods and services in the UK. You give 100 euros in Germany, you get the same sort of thing. You give 100 yuan to people in China, it's broadly the same sort of thing. I jokingly say that if you give $100 to people in the US, they spend $110 because they always spend more than their income. But even there, they broadly spend the income that they get. So the models have some similarity in the sense that incomes drive consumer spending, and if people are spending more money, you get more investment. And the econometrics of the model are driven by the differences between different countries, but the broad picture is still the same across countries. And also in the longer term prospects are driven by what's happening to population trends, what's happening to employment trends, what's happening to investment, and essentially the long-term features of CGE models are built into the longer-term aspects of this forecast. So I want to suggest that the models are open and transparent and are able to be used in a range of things for covering policy in the short term, policy in the longer term as well. And we welcome people to comment and use the models for a range of different purposes. So that's the background to the model that we've helped build here. What I thought would be useful in the last 5 to 10 minutes is simply look at a couple of scenarios that we did over the longer term, looking at what was coming out of the models for these 2 or 3 scenarios. These are not forecasts of what's going to go on, I want to stress that. These are trying to illustrate what might happen to Q8 over the longer term if certain policies are followed. And that's a very important thing to stress. These are not forecasts of what goes on, these are estimates of what might go on under different assumptions. And the first scenario that we look at is something that I call business as usual. So it looks at some of the longer term fiscal challenges that Q8 might face against the background of our central global forecast that I just touched upon. So it uses the latest world oil price outlook, and I'll say a little bit about what those numbers are in a moment. And it looks at some forecasts for Q8 oil production, both of which I'm sure many people in this room will have very different assumptions about, but these are the starting assumptions for that forecast. It takes into account the rising labour participation and supply to address the demographics here in Q8. It looks at the Article 41 of the Constitution and therefore the situation for public sector employment. And it looks at Kuwaitization rates of private sector employment, public sector earnings growth, and what's likely to happen to those given what's been happening historically. And it still assumes 10% of government revenues going to the Future Generations Fund, but that the General Reserve Fund and debt issuance are used to finance what's going on for the government deficit. And it basically also assumes there's no expenditure or revenue fiscal reforms implemented over the longer term. So there's some very strong assumptions in this, and when we spent the last week or so discussing this forecast, I think it's very important to stress, or this scenario, very important to stress that it's unlikely that things would develop this way, but it just illustrates what the current trends might lead to. Again, there's lots of numbers on that chart. I think there's a couple I want to start with. I mean, the first one is, it looks again, as you can see, out to 2035. So this model can be used both for short-term forecasting and longer-term forecasting. And as you can see, it has oil production rising modestly over that period to 3.3 million barrels per day for Q8. It assumes the oil price is relatively weak over the next few years, although many people might have lower numbers than that. It's got $60 to $70 a barrel, but rising to $100 per barrel over the longer term. That's in nominal terms. In real terms, it's obviously quite a lot lower than that. And then it looks at what happens to government revenues, various figures for public sector employment. You can see there are figures in the model for public sector earnings, the government wage bill, and government expenditure, and so on. And this very much is a focus on the fiscal side of what those trends are likely to lead to. And so that's essentially the background numbers to the forecast. But if you look at what the outcome is, it is really rather worrying, let me put it that way. Government revenue obviously rises because of the oil price and oil production, but government spending rises even more rapidly, and partly because the fiscal position does deteriorate. You can see that government debt interest payments also rise. And as a consequence of that, the fiscal position gets to a situation that I think it would be fair to say is not really sustainable over the longer term. And my first reaction to this was, well, it's based on some rather extreme assumptions, and I think it's probably fair to say it is. But I think it's still an important starting point for any analysis over the longer term for Q8, that if the current trends in terms of spending, employment, and so on were to be maintained, and if we don't see either a much higher oil price, which seems unlikely because the oil price is not very low, or certainly not as bearish as it could be in this scenario, then the situation is clearly one in which some fiscal measures would be necessary in order to limit the deterioration in the fiscal position. I think it is important to point out here that whilst and I'll go back to the assumptions, that while the General Reserve Fund is more or less depleted in this scenario, the Future Generations Fund is still broadly maintained. So this is not a situation in which the fiscal position becomes untenable. But it is one in which essentially Q8 would be spending a significant amount of the nest egg that you've built up over the last 2 or 3 decades to support current spending. And clearly that is something that is not sustainable over the very long run. And I think it would be fair to say would be something that the government would want to look at changing before the situation became as worrying as is shown there. And I think the right way to describe this is that, as you can see, the government balance does deteriorate quite sharply. Government debt does build up quite sharply. They're not numbers that are unsustainable. I don't think I would want to say that, but certainly they would indicate that there would be a looming financial crisis if those trends were to be maintained. And therefore, what we looked at in the, let me call it the alternative scenario, and we did 2 variants of this alternative scenario, was one in which measures are taken by the government to prevent that deterioration in the fiscal position. And these are all assumptions. There's nothing in here where I'm saying there's anything particularly set in stone about these figures. What we looked at was some of the things that have been introduced across other GCC countries that might well or could be introduced here that might offset that deterioration in the fiscal position. One of them was introduction of VAT at 5% and various excise taxes following similar moves, as I say, by other GCC countries. Perhaps introduction of some corporate profit tax on domestic companies from 2021. And again, some increase in fuel prices towards broad recovery levels, again by 2022. But also, in the second version of that, some modification to the public sector earnings and employment figures, and in particular having a slower growth in public sector employment over the longer term, and also having public sector earnings growing rather slower than inflation, rather than the central case where they grow rather faster than inflation. And again, a lot of numbers on this chart. I'm not going to go through them all in a lot of detail. It just shows you the VAT rate that we assumed and when it was introduced, some of the changes that we made in terms of the public sector wage bill, and some of the changes we made to various prices, as I say, fuel prices, electricity prices, in the central, or in the base case forecast or scenario that I showed earlier. And then in the second fiscal reform package, some changes again to, public sector earnings and public sector wage bill. And then these final two tables show the actual outcomes. And again, a lot of numbers on that chart, but what I want to do is show them in terms of a couple of graphics because I think they're quite useful. And as you can see, the business as usual scenario shows this substantial deterioration in the fiscal position over the next 15 years or so. The fiscal reform one, i.e. without the changes to public sector employment and public sector wages, significantly improves that, but it's only with a combination of those measures do you get to a situation in which the government balance does not deteriorate significantly. Now, I said it a few moments ago, I think it's very important to say these scenarios are also not forecasts of what we think should happen or will happen. They're simply showing you the sorts of things that you can do with the model that allow you to look at different government policies that might be introduced over that period in order to change the prospects for the Q8 economy over the longer term. And I think on top of these sorts of things, the other important thing I would have thought should be there are two important things in my view that should be on the cards. One is how you use the Future Generations Fund perhaps to help with some of the other measures to improve prospects for the non-oil sector of the Q8 economy, as well as other changes to encourage private sector development in Q8 to offset the potential problems that will arise over the longer term given current trends. And I think that's important for two reasons. Firstly, I think it's important to make those changes anyway, but almost certainly over the next 15 years, it's likely that things could be, for Q8, rather more tricky than even the numbers that I've shown you here. We've assumed here that Q8 oil production grows, and I think there's a reasonable chance of that, but clearly there's a possibility, given climate change measures around the world, that the global demand for oil could well decline really quite sharply by 2035. And it's also possible, partly as a consequence of that the oil price could be lower than what's built into this case. We use those oil production numbers and those oil price numbers not because they're necessarily what we would see as being the central case in this particular thing. We use them to illustrate that was not the problem. And there's clearly a potential scenario that you could face in which both oil production and the oil price is a little bit lower or significantly lower than what's built into this case. And that would obviously make life tougher going forward. But I think probably that's a sensible place for me to start to wind up and open the session for questions. The broad picture is one in which the world economy is rather better than many people fear, and that 2019 looks relatively good still for the global economy. Life is going to be, in our view, rather more difficult when we move into 2020, 2021. The oil price is clearly under a lot of pressure at the moment. There's a very wide range of views about where that might go. Our view is, for what it's worth, $60 is our average view for next year, but a lot of people tell me 30 or 40 is possible, and a lot of other people tell me 60 or 70 or 80 is still possible. That's our central case. But for Kuwait, the important question, I think, is not particularly the short term, because the financial position in Kuwait is actually relatively good in the short term. The prospects for Kuwait and the issues for Kuwait are rather in the longer term. And we hope the work that we're doing here, working with people, will help provide a good framework for considering those issues and potential measures to improve prospects for the Kuwait economy. Thank you very much.
Thank you, John, for laying out some important foundations for future discussions and important thematic issues that we need to think about collectively as we try to push through development of 2035 vision of Kuwait. Without further ado, we'll open the floor to questions. We'll take the first question, Marwan, please.
I already have it.
Please introduce yourself and the entity you represent.
Hello. Hello.
I can hear you now.
Thank you very much for an enlightening presentation. Your opening statement basically was complaining about your 250 economists and never agreeing on anything together. Allow me to slightly disagree. The world economies, as you pointed out, certainly aren't doing too bad now, but they have been deteriorating throughout 18. I would say it's like somebody who's fallen from the 20th floor, and he's approaching the 10th floor as he hurtles towards the concrete slab, and he says, so far so good. The indicators you gave are actually forward-looking indicators rather than other indicators such as PMIs or consumer confidence. They reflect an outlook which may or may not come to be. The other indicators such as income growth, inequality, employment, the employment figures in the USA are very much in doubt. The real income growth, wages growth, investment, inventory growth, capex and everything else. I would posit that the trend is negative. However, because of time lags in economics, they may not fully appear in 2019. But as you also point out, they will certainly appear in 2020. This is just, again, it's only an opinion, it may or may not be correct. As far as the model on Kuwait, as all models, as all Excel sheets and all models, you have to look at your first premise, your assumptions, and whatever follows from there will be based on those assumptions. No doubt, a much deeper analysis of the assumptions and the prerequisites have to be thought out, because it may look good to show that as is a deficit of 50 billion, like we will all be bankrupt in 15 years. We have to learn to play the violin. It may be good for policy to market reform politically, but I doubt that any sane person or government would sit and watch such a horrible development develop over 15 years and sit idle doing nothing. I mean, you know. what needs to be done with these models, totally new, innovative solutions and reforms have to be introduced, which to date have not been. What is adding 5% VAT, Kuwaitization here, private sector there. All this is pure bookkeeping. This is not economics. We need to think of other solutions and approaches. Thank you.
Thank you, Marwan. If you have any comments to respond to that.
Let me take your two things in turn. I mean, let's talk about the global economy first and then Kuwait. And I think maybe from different approaches, we end up with the same outcome. I mean, you seem to be saying the same as we are, that for lags in the system or for whatever reason, the global economy might do okay in 2019 and be worse in 2020. And so I think we're broadly agreed on that, but maybe you're a little bit more pessimistic. But timing is everything in economics. I always remember he's a good friend of mine, Nouriel Rabini, who you remember predicted the 2008 global financial crisis. Yeah, and I can still say it to Nouriel's face, but Nouriel, you predicted a financial crisis every year for 20 years. You got it right once, and therefore you're now famous, but you did predict it in 2006, 2007, 2005, 2003, 1996, and he predicted it for 2016 and 2017 as well. So getting it right is important, and for many of our clients who are in the real bit of the economy, it is important to know whether there's going to be growth next year that's going to be 2 or 3% or less than 1%. So the real economy clients, for them it's very important that it doesn't slow too sharply in 2019. It's true that other areas might anticipate the slowdown, so equity prices might anticipate the slowdown, and therefore their perception on things might be different. So I think that a slowdown, we still feel pretty strongly that there's lots of reasons to think that the world economy next year will grow a little bit slower than this year, but still grow. Okay, so that's, I think, the first point. Your points vis-a-vis the Kuwaiti model, for most of them, we entirely agree. A model is a framework for analysis. It is not a black box that gives you answers that you can rely on without understanding not just what the assumptions are, but what the implications of those assumptions are and the way that they feed through into what goes on. We are not in the business of simply providing models and black boxes that give you supposed answers to what's happening. We try to build you tools for analysis that can only be done with people working together to look at why the answers are coming out and whether you believe those answers or not. So we don't ever present our work in the way that some people do their longer term forecasts. So we agree that this was not a forecast of what would happen. Clearly the government would take action well before that to make some changes. And even if they didn't, there may well be reactions in the financial markets that would prevent those happening. This was not meant to be anything other than illustrations of what the longer term risks to the Kuwait economy are. And you might say, well, you know them anyway. You don't need to do that sort of analysis to do them. And that may well be true, but it's still useful to have that as a starting point to look at what the solutions might be. And I thought I said it very strongly, but let me say it again. And the tax changes that we introduced they're nothing other than accounting, and we agree. They're simply a ways of dealing with the fiscal problems that you are likely to face. They're not dealing with the underlying problems of what you might do to make the broader situation better. But they're a starting point again, because we've only been working here for less than a year. We're not trying to say that we have all the answers to all the questions. This is a framework and an illustration that the model does do the things that you would expect, because I think that's what you're saying, really. None of this thing is that surprising to you. And it's not that surprising to me, even though I don't know very much about the Kuwaiti economy. But hopefully the next stage will be to do the next stage of analysis, which is how do you make things better? What is the best reform that can take place? And that's not just a question of VAT at 5%, it's other things that need to go with that. Is that okay?
Thank you, John. Next question.
Thank you very much. Regarding the Trump strategy and retaliation of the rest of the world, if we put the rest of the world together, are they willing and able to retaliate? And if they are going to do this, how long will it take? And will this make the whole situation collapse, the whole trade system? And what is the role of World Trade Organization on this as well? If we can, from your perspective about your clients across the globe, can we see those major players retaliate against the Trump administration protectionism and do the same, taking the same position, and this might drive the whole system to a point of, again, a financial or more crisis?
That's a good question, and I gave a very quick description of the trade war situation, and it's something I could talk about for an hour, and I clearly don't have an hour to respond. I think there's various things to say. Currently, the measures have been very much focused on China. That's partly economic, and it's partly political and strategic. It's important to remember the two things are linked. What President Trump is wanting to do, and it's easier to say in this room than in a wider audience, he is clearly trying to limit China's longer-term threat to the US economy, because he does see that as a threat, as do other people. It's not just Trump. The Democrats would probably be just the same on this. It's, I think, important to remember. But he is also trying to deal with economics, and he's trying to reverse the trend of globalization, where US companies move production from the Midwest, which voted for him in the elections, to other parts of the world, but particularly to China. Now, currently the measures will encourage people to move some production maybe back to the US, but just as much to Vietnam or Thailand or anywhere else. So you might argue that he might want to broaden them to other parts of the world. I think he won't do that because the politics is not the same. He will want to encourage things to come back to the US, but the main thing is to move them away from China. So I think you'll see a little bit of both. You'll see US companies moving production a bit back to the US and a bit to other parts of Asia. Is he likely to extend it across all of trade, which I think is the implications of your question? I think the answer to that is very clearly no. We always believed he would not give up on NAFTA. He wanted to renegotiate NAFTA, but he didn't want to get rid of NAFTA, partly because NAFTA was very strongly in favor of US. I mean, there was lots of US companies benefiting from NAFTA. He just wanted to change it. So NAFTA has already been renegotiated. I don't think he really wants to change the situation with Japan or other parts of Asia. He has some big concerns about Europe, and I indicated those, and particularly Germany and cars, and I think he has a case there. The economic case is not good for what happens with European cars. So I can see that being an issue. But I don't think the Trump administration wants to broaden it to everywhere in the world, and therefore I can't see the rest of the world collectively retaliating against him. It it is much more likely to be China and Germany that are going to be threatened by this rather than a global thing. If it became global, I think the risks to the global economy would be much more serious, because I think then we would get a situation in which trade collapsed and we could move back to a much more serious situation. But even there, you've got to be careful about overestimating the effects. Many of you may know Paul Krugman. He wrote a very good article about trade a few months ago, saying, look, trade is good for the global economy, but don't overestimate the benefits from that. They're not 10% of GDP, they're 2 or 3% of GDP. So it would be negative for the global economy, but not the disastrous numbers that you'll see quoted in some newspapers. Is that a good answer?
Next question. Yeah. Please state your name and the entity you represent.
Bhaskar Majumdar, Chief Risk Officer at the Industrial Bank of Kuwait. I will go back to what you were talking about, globalization. Now, we are talking about globalization now, but globalization started probably 25 years ago. And at that time, and I'm coming back to economic theory and the applications of economics, I think the world became very, very connected. Wage rate differentials were, huge. American wages were very high and Chinese wages were very low. That is why the relocation occurred, But now, if you reverse itself, if you reverse the process, the effects, the good effects of that, which is lower prices of goods and services and all that, do you think that will reverse itself? And my second question is, the way economics is done, I don't think it is followed up in theory and practice, okay, with the level of globalization that is there and has been the case, because governments basically act as if they are in an autarkic situation, okay, whereas the global markets are very, very different. The Fed raises, QE, Indian markets go up and Vietnamese markets go up and Chinese markets go up, okay? So, and these flows are just called leakages this time. I think it is much, much more than that. World financial flows are many times more than trade, okay? And so are the interlinked factors. And I think China is making some headways there with what a global picture. I don't think the US has, because it's looking after itself, okay? And so what do you think is the final, China, for example, is concentrating on its domestic economy. With its population, it can do that, okay? So what do you think is going to happen in the shift of economic power that was going China's way? Do you think it's going to, I know that the US is far ahead in terms of GDP terms currently, okay? But what do you think is going to happen, say, 10 years' time? And what do you think is the analysis? Do you think the analysis of economics as such, as a subject, as taught at our universities, catching up with what is happening in the real world?
Let me take it again a bit in stages. Globalization there was a number of strands to globalization. Some of it was financial, and financial flows, both FDI flows and other financial flows, were part of the globalization story. And I'll talk about those in a second. The second big globalization story was about moving production to cheaper areas, your point about low wages. And that wasn't just from the US to China. I remember the US moved a lot of production to Europe 20 years ago because of low wages in Europe. Seems surprising now because wages are the same, but a lot of production came to the UK and came to other parts of Europe from the US because of low wages in Europe. But the third part of globalization was immigration, which was movement of people from low wage areas or poorer areas to the richer parts of the world. Now, it seems to me that economics forgot about what we'll call populism here, or you might call democracy as well. It didn't realize that globalization in terms of goods and globalization in terms of immigration caused some significant negatives for a number of countries. and the Midwest of the US clearly reflected that. Northern England, where I'm from, clearly reflected that. And the people in the north of England and the people in the Midwest are the ones that voted for Brexit and voted for Trump. But it's not just in those countries. If you look at what's happening in Germany now or in France, you see exactly the same trends. You know, they may result in different policies, but broadly speaking, the implications of globalization, which was good for goods producers, and immigration, which helped many poor countries, did not help a number of people in those rich countries. And they are now saying they don't want any more of it. And that is not going to continue. You know, Germany will not take 1 million migrants again, as it took in 2016, ever again. The UK, they will not do the same. It will simply not happen again. And going back to President Trump, some of it is to do with the Mexican border and the wall that he keeps talking about, but quite a lot of it is people coming from parts of Africa and parts of the poorer parts of Asia into the United States. Those trends are not going to continue as they've done over the last 25 years. And that's where economics and politics mix. And I think you'll see the same thing in terms of financial flows a little bit as well. I think even the IMF now sees that some of the financial flows, the free financial market situation, cause problems for emerging markets. It's actually causing them problems at the moment because the financial flows are going out of emerging markets. So I think the move towards globalization on all those three fronts will not return. It's not just about President Trump. It's not just about Brexit. If the Democrats win in 2020, you'll see exactly the same sorts of things going on. So we saw it, you're quite right, we saw it for 25, 30 years. You might argue it started after the Second World War and went on for 30, 35 years in differing degrees. That has come to an end, and we need to allow for that. That's I think, a critical point of what I would say. How do we deal with it? It's quite difficult, because the economics says that's good for our economy. And it may well be good for our economy, but it's not good for sections of the economy, and we need, as economists, to start to allow for the fact that Pareto optimal, or whatever you want to call it, is not good enough. Everybody's got to vote in these countries, and the people are not going to vote for what's going on. And we try to build that into our models. One of the things that we're working on with the US government now is exactly that sort of issue. How do you build into models consequences that allow for the politics of what goes on? Because the models are no good if they don't have the right politics for what goes on. It's slightly different for you here in Kuwait because the system is different, but there's still elements of that. You need to allow for the politics of what goes on. And in a way, it's the same thing with your question. And that we might not have, it's not easy to build politics into these models because you've never done it, but you need to build politics into the models. And that's the next stage of what we're trying to do, but we're not there with your model yet on that one. I hope that answers your question.
Thank you, John.
Non-linear, oh, absolutely. And I'm sorry, I would totally agree with that. But that's even harder to deal with. You know, when do these things switch from one thing to another? But you can have non-linearities, you just don't know how they work. You don't know when they come in.
Thank you, John. We'll take one last question, the gentleman in front.
Yeah, thank you very much. My name is Abdul Karim Al-Fawzan from Central Agency for Information Technology. My background is IT, so I'm going to ask about a question about the IT. The predicted 2020 recession that's coming, might come, actually. How would that affect the IT trends, like the artificial intelligence, machine learning, and all these stuff in IT? Would they benefit from the recession?
They haven't benefited from the worry about it, have they? If you look at what's happened to Amazon and Apple's share price. My view is that some of those trends are separate to the global economy. The movement towards, I mean, I'll just choose Amazon because it's in my view, it's a classic example of what's going on. Amazon and the growth of Amazon is not going to be significantly affected by the slowdown in the retail sector, because of the consumer sector, because they're taking market share from all of the other retailers, and therefore will continue to grow relatively rapidly, in my view. I would apply exactly the same thing for Apple. Yeah, they might be affected a little bit more than Amazon because people have got to buy those things. But my children, if they want, the only thing they really care about is buying the mobile phone. That's the only thing that matters to them, and probably even for me nowadays. So they're not going to buy cars any longer because they don't worry about driving cars, which has implications for oil. They don't actually buy clothes that much, but you look at the amount that they're willing to spend on the mobile phone and the apps and the other things that go with that. That is like a necessity for them nowadays. It's sort of food, and then the phone is the only thing that would matter to them. So I think those IT trends are going to be affected a little bit, but much less than people think. Deregulation may be a factor because of concerns from politics, going back to my previous question, but that's a different set of issues. I don't think economics is going to have as big an impact on those things, because those are sectoral shifts that are taking place no matter, and are driven by technology, in a sense, by what you said. So that those things are going to happen no matter what.
Thank you, John, and that'll be it for all the questions. As we usually have in KPPC, we have a last comment by His Excellency the Secretary General, and he's not here today, so I'll just briefly comment on an important fact as we think about the model in the future of the next 20, 30, 40 years, is the key question of educational reform. With automation, IoT, AI, and such, as Mr. Fawzan rightly mentioned, is a key question of reskilling the labor market. Most of our jobs will be obsolete in the next 30, 40 years, if not even earlier. So this is a key question to look into account when we look into the model for the future.
Do you want me to answer? Yeah.
Sure, maybe if you can just briefly talk about that real fast, and then we'll wrap it up.
I mean, I think you're absolutely right that those trends are going to change substantially the way our economies work over the longer term. But I can still imagine there will be new jobs created in other areas. I think the real test for the developed world and the GCC and Kuwait is being able to be successful in the new technologies, but also create jobs for the wider population, because you will always have a wider population who don't have all those skills. You've got to have the really high-skilled jobs and the really high-skilled bits of your economy, but there will still be things, and I always use this example, I hope you take it right. You're looking after older people like me. I'm getting old and grey, and older people will need care and attention, so there will still be jobs for people that don't have those high skills. And you've got to get the right mix to create jobs for the best of your population and remain competitive in those areas, but also look at the less skilled people, because they are the ones also that matter. Coming back to what I talked about earlier, you need to make sure that those are happy and have got worthwhile jobs. And that's going to be the test, not just for the US and Germany, but for Kuwait and for Vietnam.
Perfect. Thank you, John, for enriching discussion, and it's a wrap for today's lecture. Thank you, everyone.
Thank you.